Good afternoon, everyone. Hello. Good afternoon. Welcome if you're tuning in now, or if you're joining us in the room for the Politico Competitive Europe Week Summit. My name's Carlo Martuscelli. I'm an economy reporter at Politico. And today we'll be speaking about the Capital Markets Union, it has a new name now, apparently. We'll be discussing that too. And the issue is that Europe needs more investment. So Mario Draghi said it needs about 4 to 5% of EU GDP more. And much of that money is going to have to be private capital. Only a small part of it can be public money. So the question is, how do we get that private investment into all of our societal needs, whether that's more solar farms, tech startups, or new infrastructure projects? So reform of the EU's financial markets is one obvious answer. The thinking is, if we can just get the rules right, then we can lure European savers who at the moment prefer to leave their money in the banks. And we can get them to invest more like their American counterparts already do. The issue is that we've been talking about capital markets reform already for 10 years, and it hasn't happened, or it has happened, but only somewhat. So progress has been, to put it mildly, slow. Still, the issue is on the agenda yet again, though now it's been rebranded as the Savings and Investment Union. Is this the time that we finally get the CMU right, or are we going to be here 10 years from now discussing it again? A brief reminder, talk about us on X or the social media platform of your choice, and you can use the hashtag Politico Competitive Week. Without further ado, I'm going to present our panelists here today. So a big thank you to John Berrigan, Director General at DG FISMA at the European Commission, Mark Branson of the Federal Financial Supervisory Authority, or BaFin. We have Dirk Schmitz, Managing Director, Country Head for Germany, Austria, Eastern Europe at BlackRock. And we have Thierry Philipponnat, Chief Economist at Finance Watch. So thank you very much for joining me on the stage here today. I like to get things started with a little icebreaker question, so please keep your answer short to a minute. So do you think the second von der Leyen Commission is going to be able to make some serious progress on the CMU? If we can start with you, John.
Thanks. Well, first I should correct you. Some of us have been 20 years working on capital market. I think yes, and I think for two reasons. One, I think the context is a bit different than in the past. I think if you compare the context to this von der Leyen 2 to von der Leyen 1, I think the geopolitical context is different, the globalization context is different, and so the discussion around capital markets is different, because back 5 years ago, it was still, I think, thought as something that was kind of nice to have, a way to diversify your financial system. You know, we had a very good banking system, but it'd be nice to have a capital market as well, but we could rely on our banking system. I think it's become clear in the last 5 years that, in fact, that's not the case. So we need, rather than would be nice to have, we need to have a capital market, because the sort of industrial transformation we need in the 21st century is all about innovation. It's all about small, riskier sort of investments where banks are perhaps not best placed. So now we see a hole. And I think if you read the Eurogroup statement, they see the hole. Now, of course, you have to fill the hole, and that's no easier because you have a different narrative, but it does mean that the urgency is a bit stronger.
Mark?
Yes, because the sense of urgency is different. I think if we look back 5, 10 or more years, this topic of developing capital markets was associated with a lack of ambition, a lack of urgency, and therefore a lack of ambition, a lack of understanding, and sometimes a lack of willingness to engage with a topic which is seen as, you know, a little more dangerous, maybe than banking, and a lack of clarity of vision as to what actually needed to be done. So we ended up with something that has been not a failure, but has been piecemeal and somewhat half-hearted, I think, from my point of view. And I think, as you said, now the sense of urgency is there because we've realized why we need to rebalance the financing streams that we have in Europe to deal with the challenges that we have. There's less of an unwillingness to engage with the topic at the political level. So there are more grounds for optimism. Doesn't mean it's easy. Doesn't mean that just rebranding will do the trick. But I guess we'll come on to that.
Great. Dirk?
Yeah, also good afternoon from my side, and thanks for having me. I would agree the urgency is higher, the demand is higher for Capital Markets Union, and the reason is twofold. One, we need a good private system for old age provisioning across Europe. There are only very few countries who are in a good shape when it comes to old age provisioning. There are far more countries who need to do a lot of homework when it comes, to old age provisioning.
Sorry, we're talking about pensions there.
Pensions, pensions. And the second reason is we have a lot of investment needs. I mean, there's a lot that needs to be done, whether it's decarbonization, whether it's moving into the digital world, and many other topics where we need a lot of capital. And in order to provide that capital, we also need the Capital Markets Union. So yes, the urgency is much, much higher.
Thierry?
My answer to this would be hopefully. And certainly it's the right objective. I have no doubt about that. We should all row in the same direction. Also strikes me that the lowest hanging fruit have already been picked up. So what remains to be done is politically difficult. Let's call a spade a spade. And you know what? I would bet that, say, among the 4 technicians on this panel, we're very different. We would agree on 90 or 95% of what needs to be done, but we're not politicians. And that will be the real difficulty. So yeah, let's as technicians, let's use our power of conviction, if we have one, to tell our political leaders this is democracy, so they have the power, that they have to do it and overcome a number of barriers. I'm sure we're going to discuss them now that still exist. Just one thing on the fact that we do need to complete the CMU, but it will not do the entire job of financing what needs to be financed in the European Union. It struck me when the Draghi report came out that it said that. It struck me that the Letta report said it. Because Letta report said something which was very interesting. It said, the investment we need to make are not only about financial considerations. And you know what? Private capital, and there's no moral judgment in what I'm saying, is about getting the right return for the risk taken. End of story. So if you don't have the right return, in other words, if it's not bankable, private capital will not come. And a significant proportion of what needs to be invested in is not bankable in the traditional sense of the word. And Finance Watch came out with a report on that in July, and we estimated that about a third of what needs to be invested, that's really several hundred billion euros per annum, well worth doing, is bankable, but the remaining 2/3 will need to find money elsewhere, but this is not the topic of the day.
Okay, we'll return to that point because I think it's good to also, as a journalist, I appreciate a skeptical note as well. So I'd like to hear a bit more about what the CMU can't do as much as what it can do, but we can go back to that. But I'd like to start with you, John, new commission, new commissioner. The CMU now has a different name. It's the Savings and Investment Union. So are we, in this new commission, are we going to get a completely new paradigm, a new idea of what the CMU can be, or is this more about implementing what we've already been discussing for the past 10 or, I guess, 20 years?
Maybe I'll break that in two.
Yeah.
I mean, I think if you read the political guidelines, the president says a savings and investment union which incorporates capital markets and banking. So I see the savings and investment union as something that encompasses the entire financial activity of the market. So it's both capital and banking. So in a sense, you can put CMU and banking union under this heading of savings and investment union. So I think that's how we should interpret it.
Yeah.
I mean, actually, these headings don't matter because they're too often seen as kind of vanity projects of Brussels. I mean, we like to build unions, we like to build infrastructures, etc. It is, in fact, about the economics of this. So I like this change mainly because it allows us to speak about financing the economy and not about unions and not about architectural changes, etc. It's about financing the economy. So that's the first part. I think your second part was what you...
Whether it's about implementing the program that we already have, or if it's about new ideas.
I mean, there's nothing new in CMU. After 20 years, it's very hard to find something that we haven't talked about at least before. But there are plenty that we could do that we haven't done before. So I tell this story a lot, but when we were preparing our dialogue with the UK, we looked at the two agendas, and I discovered we were both doing the same things. So there was a lot of crossover, a lot of alignment in our agendas. The difference is they have a single market and we don't. So if they're doing all this and they have a single market, what are we doing? Well, what we're doing is maintaining the market we have. And that, I think, is what we have been doing a lot of in the last 10 years. We have been improving the market we have. So we have done listing acts, we have done prospectus, we've done IPOs. So we've been making the market we have work better, so trying to tweak it. But what makes a single market is single laws. And single laws in places which, as Thierry said, and others have said, are politically very difficult. So in supervision, in taxation, in insolvency, in corporate law, this is all tough stuff. But this is how you build a market across the union. You have to do this stuff. We have to be smart. If I go to a justice minister, and it is a justice minister I have to speak to, and say, I'd like you to revise your entire insolvency framework so I can have a capital market, he's going to remind me that that's not the reason he has insolvency law. But if I can say to him, there are 2 or 3 things in your insolvency framework which I would like to harmonize, which would help me, then it's a little bit better. And similarly with pensions, I cannot go to whoever it is responsible for pensions and say, I'd like you to reform your pension system to build a private pension so I can have a capital market. No, I mean, pension reform will be for bigger reasons, social sustainability, fiscal sustainability, and then the capital market becomes part of the solution. So I think the very fact that we're having these kinds of debate, difficult and all as they are, is, to kind of go back to what Mark said, it's a realization, I think, on the part of the politicians that they have to work in this space now. They know it's going to be difficult, but they can't really avoid it. So, of course, it's going to be tough. These are very tough decisions, but at least there's a recognition that we go there. So we will be doing different things to what we did before.
And can you just make the link very explicit? Where do the pensions come into this? Because a capital market, one might imagine it's a place where you can buy and sell sources of financing. I guess pensions are a way to get money into the system. Is that the idea?
Yeah, I mean, it's pretty straightforward. I mean, if you want to have a capital market in the union, you're going to have to boost retail participation, which means you have to move retail savings out of deposits and into capital market instruments. So that's, are you going to rely on direct retail participation? I think not. This is going to be done through intermediaries of one kind or another, and the pension reform is one way of doing that. It's sort of replicating what has worked in other parts of the world and in other parts of the union. So that's where the pension fund comes in. But as I said, the pension fund and the market are in a way parts of a solution to another problem, which is in many ways more important, which is how do we sustain our social model going forward? How do we ensure that our public finances don't explode? This is the sort of thing. So we're not doing this to create a capital market. In many ways, we're doing both pension reform and capital market reform to address a bigger sort of problem.
It's a means to an end.
It's a means to an end.
Mark, first of all, do you want to reply to any of that, just because I saw you taking notes? Or
I mean, really resounding agreement. I think the capital market in Europe needs to be deeper and more liquid and more efficient. That is essentially a wholesale market issue. You need to make the wholesale market more attractive and lower cost.
Can you just explain what wholesale means in this context in a word?
It means, in contrast to the idea that motivating individual investors to participate themselves will pull the market along. Like John, I believe that the the money that is there for individual investors for their future is going to be largely deployed by intermediaries. And if we're thinking about long-term savings and pensions, that's even more the case. And actually to get a deep and efficient capital market that looks a bit more like what you might have in the US, you have to tackle some of the nitty-gritty plumbing issues. We have 27 central securities depositories, and that's the end of the process chain. Everything ends not in one place, but in one of 27 places, if you're talking about equities. And that is always going to be an inefficient solution. How do you start to change that? You need to tackle some of the tough stuff that Sean was talking about, the insolvency law provisions that make that harmonization there difficult, and therefore means that the market stays fragmented. So you have to get at the legal issues and the infrastructural issues and the process issues, deep in the nitty-gritty of the market and the legal regimes, and that's heavy lifting, and won't be solved by more disclosure and trying to make the markets more attractive for the individual. The individual has to trust in the end that the markets are fair and the markets are cost efficient, and that's why I do think the pension theme is the biggest single theme, just because there has got to be, and there is, a wall of money there that needs to be better invested than it is today at lower cost. Because
Are you amenable to giving up some of your national rules to a wider European regime?
Well, I'm a supervisor, not a regulator, so not my rules. And I do think that the only way to move this forward is to harmonize parts of those rule books. And as you say, and as Sean said, insolvency law is a major part of that, and that has many other ramifications. Or in certain areas where you can't harmonize, to create a 28th regime that allows certain actors, if not all, to work at a parallel level.
This is Lenta's idea.
Yeah, without one or the other, we're just going to stay where we are and do more window dressing. Because in the end, you've got a single currency like the United States, but we've got a fragmented set of 27 jurisdictions that are part of the intricate workings of the capital market, and that's gonna cost too much and be less attractive, be less liquid, and we shouldn't wonder then that IPO frequency is higher on the other side of the pond, because you can go straight in and access one homogeneous market. So we've got to increase the homogeneity.
Great. Dirk, I wanted to make this all a little bit more concrete, because at the end of the day, what you have, I don't want to say in the real world, this is all the real world, but in the markets, you have people, institutions, buying and selling financial instruments or making investments in projects. They're having to, make decisions based on expected returns, and then keeping in mind all of the, legal difficulties that might come from investing in one place to another. So what does it look like for you as an investor when you're having to deal with these things? And if you can give any concrete examples, that would be great.
Yeah, absolutely happy to do so. 2/3 of our clients are using BlackRock's products in order to provision for old age, for retirement. So it's a private supplement to their state pension. We all know that the state pension, the levels of state pension are going down. So people kind of have realized that solely on a state pension, maybe you cannot live, as you want to live when you retire. So 2/3 of the clients are coming to us, are using our products, for instance, our ETFs, in order to save for retirement. So in Germany, we have our German ETF range situated under the supervision of BaFin, obviously in Munich, around 50 billion euros of ETFs.
Can you just explain what an ETF is? I'm sure most people know, but...
So an ETF is an exchange-traded fund. So it's a mutual fund that follows an index, for instance, the DAX or the S&P 500, and does that in a very efficient, cost-efficient way and in a very liquid way. So you can buy or sell your ETF daily on an exchange, therefore it's called exchange-traded fund, and it's usually very cost-efficient. So people are saving into our ETFs, in order to have some money for when they retire. As I said, our German ETF range is situated in Munich. I have the honor of being the CEO of that legal entity. And when people invest into our ETFs, those ETFs are investing into single stocks across Europe. So if you, for instance, buy from us a sector ETF, so an ETF investing into the chemical industry or into the car industry, the ETF would invest into car companies across Europe. I, as a CEO, need to spend a lot of time and money then in order to get withholding taxes back. So what does that mean? These single stocks that I have bought on behalf of my clients, they are paying dividends. These dividends are subject to national withholding taxes. So in most cases, there are double taxation treaties between the different countries within the EU. So I, as a fiduciary, on behalf of my clients, can claim those withholding taxes back. So far, so good. But as Mark was saying, I'm dealing with 27 different processes. I need to hire 27 different tax advisors in 27 different countries. And sometimes I'm waiting years to get my withholding tax back. So therefore, Thierry, I want to disagree slightly with you. I think there's still a lot of low-hanging fruit. I wouldn't agree with the statement that we have harvested all the low-hanging fruit. There are still some low-hanging fruit. And John, I agree with you, because I think we don't need to change the tax laws. So if I was sitting here and if I was saying, let's harmonize all the tax levels across Europe, that would be a big task, right? We would need every head of state to agree to that. But I'm not suggesting that. That would be too difficult. But let's harmonize the process of getting your withholding tax back, which is your legal right. Let's not make it lengthy and costly. Let's make it efficient and let's digitalize it so that for us and others, it's very easy to get the withholding tax back and therefore have a quicker and easier return for our clients.
Yeah, just to join the dots here, obviously, the easier you make it, the less fees you have to charge your clients.
I have to hire KPMG in 27 countries. And you kind of can guess what KPMG is costing in 27 countries. And they need to go to the local tax authorities. They need to fill out forms. And sometimes it takes 1 to 2 years. This should be digitalized, and it should happen automatically, that all the withholding tax gets reimbursed into the account of the client without any paperwork.
An important point, it's costing the client.
Right.
It's not costing his bottom line, it's costing the client.
This is the point I wanted to make. And that means people maybe will invest less because it's more expensive. Yeah,
I just want to come back on that because there's some good news here. We have a proposal which has been adopted, the so-called FASTER proposal, which since it's been around for about 20 years, perhaps it's not that.
It's very fast.
It's very fast. But the FASTER proposal allows a harmonization of withholding procedures. So that's the good news. The less good news is that a large number of member states sought exemptions from the harmonization. And the logic they applied was, of course, I was discussing this with Mark earlier this morning, was that because I don't have a large share of the integrated market, I don't need to change my procedures. When in fact the logic should be the other way around. If you want to build your share of the market, you should want to change your procedures. So I think there's also, somebody I think it was Madame Yon Cortin was talking about financial education. There's also financial education, not just of the retail. We all have to become a little bit more financially educated about what works and doesn't work if you want to integrate your market. And exempting yourself from a withholding tax adjustment that opens your market to integration perhaps isn't the way to go. But that's where we are now. The larger member states have agreed to this, so it will get easier for you in the future. But you probably still won't want to go to some of the smaller markets because you will face that problem.
Great. I'm going to do a bit of an abrupt turn now into politics here. Thierry, this is to kind of return to the point that you already brought up, that CMU is great and good, and I think most people that look at it from a technical point of view can agree that it makes sense to build a more rational, comprehensive market. But do you think this idea sometimes gets used a little bit as like a deus ex machina for politicians who maybe don't want to have hard discussions on financing, especially those projects which maybe it's hard to get a kind of market attractive ROI, as a way to not discuss raising joint debt or other forms of borrowing, and you just say, we'll do the CMU and that will solve the problem.
Yeah, definitely. And if you allow me 10 seconds on the low-hanging and low-hanging, the exchange between Sean and you showed that it all depends on your definition of what low means. How low is low? Anyway, back to your question. Yes, I heard, doesn't matter the names, very high-level leaders of the EU say probably 6 or 8 months ago that the EU's response to the US IRA was CMU. In my view, this is not coherent, in all due respect for the person who said that. Why? Look at the US. They have by far the deepest capital markets in the world. If we ever come close to what they're doing, we'll be very, very, very good. Despite that, they've committed a very substantial amount of public money to what we know through the IRA. Highly conscious that this is super difficult, that we're not comparable because we're not one country, that fiscal capacity. There's so many technical and political issues. I'm very, very conscious about that. I'm not saying let's do like they're doing because it's not that simple. All I'm saying is that CMU, or whatever you call it, is not a response to the IRA. And that at the end of the day, even if you have deep capital markets, private capital, I'm repeating myself here, but it seems to be forgotten sometimes at a very high level, whether at country or sometimes at EU level, because it makes for an easier political speech or narrative that private capital will not come if you do not offer the proper return. It's just a fact. And we heard in previous session the different MEPs. That one thing that struck me is that the narrative that EU savings are being invested outside of the EU is getting momentum. If I'm not mistaken, we're talking about 300 billion euros per annum, roughly. 300 billion is 12%-ish of the savings of European citizens, and 3% of the market cap of the EU. A lot of EU companies have up to 40% of their shareholders as non-EU shareholders. So if really the objective is to stop that 300 to go outside of the EU, well, there's one very simple solution I'm sure nobody wants, is, remove the freedom of circulation of capital and say you're not allowed to invest, outside of the EU. Job done. Nobody wants it. I'm not saying I want it. All I'm saying is maybe this is not the right objective because, freedom of capital, or we completely change the system, but I don't think we're debating about this now. So we really need to think about that. And this is also about getting attractive economic propositions in the EU economy, and that's not financial, that's industrial, that's service, that's providing, good story in the most positive sense of the word to investors. And this is what we're talking about. So yes, I would tend to say that, at a political level, sometimes it's the easy answer and sort of, sorry, I like provoking sometimes, kicking the can down the road, and by the time we discover it was not a problem, I'll have another job. Sorry, I'm being a bit provocative here, but it's that's the message. So the message, I guess, is yes, let's do it, but let's not assume that once we've done it, if we manage to do it, despite the obstacles, everything will be done.
Does anyone want to respond to that? Or no? If not, Dirk, I don't want to veer too much off topic here, but since we are discussing financing, do you think we're underestimating how much private capital can meet the Europe's infrastructure needs, investment needs? Like, is there a kind of wealth of good projects that we just need to get the rules right, and we could, drive a lot of growth?
I definitely think there's enough private capital to meet most of the needs. But what we need to do is we need to translate the political will into bankable projects or into investable projects. And that translation sometimes is not happening. So obviously we need to formulate the political will, and that is done in many different parliaments and by different governments. And this is all discussing what we need, how our future should look, decarbonized, digitalized, etc., etc. But then you need to break it up and translate it into investable projects. And I would say that you should first try to do that with every single project. And then there might be projects where a sufficient yield is not available. And then you can obviously make the decision from the government side to subsidize it, right? Or to do it with taxpayers' money. But in most cases, I would say it can be made into an investable project. Of course, we need a yield because our clients, as I explained before, are saving for their retirement. And if we said to them, yeah, but on this project there's no yield, but it's for the EU, they still wouldn't be happy, right? They would still demand an adjusted or an adequate yield. So I think enough private capital is there, but between the EU, the national state, and the regional states in some cases, we need to make sure that we break it up into investable projects that can be put into a spreadsheet. We have good examples for that. For instance, in the North Sea, obviously wind projects, the rights have been auctioned off from Germany and other states over the last few years. And those are very good projects where it shows that private capital can do a lot. But in other areas, for instance, grids in Germany or electricity grids in Europe, I think we are still far away from breaking it up into investable projects.
Do you want to just say something very quick?
Yeah, very quickly, a major investment that needs to be made that I'm struggling to find any bankability in. European Environment Agency tells us that rising ocean levels will cost €1 trillion per annum to the EU economy. That's 6% of GDP of the EU. In order to prevent that, you need to build the right infrastructure. You need to build the seawalls and everything. That is not going to produce any return by definition. So is private capital going to finance that? I seriously doubt. If we don't do it, 6% of the EU GDP. I mean, it's enormous, even in terms of impact on revenues, fiscal revenues and everything. How do we finance that? I mean, we need to get our brain going on this. And this number is from very official number.
Just to return to slightly more technical matters on the CMU. I mean, John, we talked a bit about low-hanging fruit, high-hanging fruit. I don't know if that's an expression, but what do you see as the most immediate goals that we can reach in this new commission? Is it single supervision, securitization? Where might we see progress first?
First of all, I have banned the use of the phrase low-hanging fruit because the ones that looked like low-hanging were very tightly attached. So this is my historical experience. So we don't use it. I think it's not about identifying low-hanging fruit because I mean this is one of the problems with capital market development is that there's no silver bullet. This is what makes it hard to explain to a politician. There's just not this one thing you can do that will either achieve the objective or set in train the momentum that gets you there. It is about doing lots of different things at the same time. So really it's not about choosing low-hanging or other hanging fruits. It's really just about thinking where you need to work in the market. And you need to work in all aspects of the market. We need to build demand. We need to improve the efficiency of supply. We need to improve the infrastructure. As Mark was saying, we have a lot of infrastructures that kind of we wonder we need them all, frankly. And then you must look at the oversight of the market. So I'm not going to sit here, and certainly not because I haven't discussed it with my new boss, but I'm not going to tell you what's coming first or second. But my point is that's not the point. Some of the most important things will take time to prepare. So they may come later. Some of the less important stuff will be easier to put into place, but we will see. But it's not about thinking it in those lines. It's about thinking about, you're not going to do it all in one bite. What are the sort of most impactful things you can do in the various parts of the market? And while I have the floor, just to say that I'm not going to comment on public-private beyond saying that the political priorities make it clear there is a role for public money here. But there's a difference between public expenditure and private expenditure. You allocate public expenditure. You raise taxes and the policymaker says, I think I'll spend it there and I'll spend it there and I'll spend it here. You attract private money. So you need a much more coherent policy in order to attract money in. So it cannot be that you want private investment in green, but you're still subsidizing fossil fuels, that kind of stuff. And what I liked about Draghi was he also makes it clear that we can do a lot in capital markets, but it's not the only problem of allocation. It is a problem of allocation in the EU. I mean, we have lots of savings and very low productivity. So there's something going wrong in the allocation of resources. The capital market plays a big part in that, but you need reforms elsewhere as well. Energy, you need reforms in labor markets, you need reforms in lots of places. And if you put all your eggs in the capital market basket, you will be disappointed. So it is part of the reform, but it's a part of the reform. And if you don't make these other reforms, I think it doesn't deliver, frankly.
Mark, is there anything you want to add to that?
Yeah, I mean, I agree with the point that this is not the wonderful answer to all the financing challenges that we have. In the end, private investment will always flow to things that are profitable and legal, and it won't flow to things that are either unprofitable or illegal. That's just the way it works. The marginal cost of financing in Europe over the capital market is too high, and if you reduce that, you bring more projects at the margin in that zone of being profitable or having an attractive risk-return profile. So it's just a way of shifting more things to be financeable. It doesn't create more finance. The money's either there or it's not. It just makes more things attractive to finance because you're losing less money in the friction of operating the infrastructure. I think what we also have to be aware when we go at these various projects is that we have a few problems to solve in the way that we're currently set up, and they're not limited to the way the capital markets are regulated. But we have a problem with convergence in supervisory approaches, which you can either deal with by more centralization or more discipline. I mean, either or, but we do have a problem there. We also have a problem.
Do you mind just defining that? I mean, I guess each supervisor doing their own thing.
We have many single rule books which are very dense, but at the same time they then need to be interpreted, and they're interpreted mainly nationally. And if there's room for divergence, significant divergence in interpretation, that's an arbitrage opportunity that the financial sector will use to the detriment of stability or consumers. That's just a fact.
So they'll go to the most relaxed supervisor.
Yeah, water flows downhill, right? and so there we have something that needs to be solved if we want also to bring retail trust back to the capital markets or increase that trust. We also have a problem with the sheer density of the regulation that we have created, with all the technical standards underlying the lawmaking, which is in itself a cost, and we have a lack of proportionality. And what we've tried to do is solve the supervisory convergence problem by creating more rules and reduce the discretion. And I think that's the wrong philosophical way at it. So you need to think, how am I going to solve the supervisory convergence conundrum, either by disciplining supervisors more or centralizing more, and then I would need less rules to make sure that they don't create arbitrage opportunities in these 27 places.
So you're okay with centralizing supervision?
I think you can do it in two different ways. As I said, you can either discipline what we have, or you can centralize more. Obviously, if you centralize everything, you've thrown subsidiarity out of the window, and it's a big leap from where we are. So you could well have parts of the market which are more centralized in the supervision and others which are more local, but the more locally supervised needs to be heavily disciplined to make sure that there aren't arbitrage opportunities which are going to be taken advantage of. In particular, we're talking about virtual products in a digitalizing world which move via a passport cross-border into a market where the consumers could be harmed if there isn't the same supervisory standard. So I think thinking about I think we've reached the limit of what we can do with the density of the rule book. I think we're actually over that limit. So we need to think how we can go at the question of creating convergent supervision without changing the level of the standards. So reducing the density of the rules without softening the rules.
Right.
Those are two very different things. I think that's what we should be aiming for.
Great. I mean, Dirk, I did want to ask you as a market player, someone in the market, we've been a little bit maybe pessimistic or hard on the CMU and its progress over the past 10 years, but have you seen things improving in Europe in terms of the maturity of the financial markets? Is there still this feeling that we're still so far behind the US in terms of the functioning of Europe's capital markets?
So obviously there have been successes, but unfortunately it has taken a lot of time in order to reach those successes. So therefore we are turning a little bit too pessimistic, I have to admit. So what are these successes? I mean, if you think about the joint legal formats that we have for some products, I think there are real success stories. One is obviously the UCITS format. So that's the format for a mutual fund across Europe. And as Mark was describing, this product can be set up in one country and be passported into all other EU countries. A second one is the LTIF, for instance. That is a fund structure for alternative investments. We were talking about the needs to finance infrastructure and long-term, sometimes also illiquid projects. And in order to collect the funds for that, you need the LTIF if you want to do it from individual investors. That structure has also been introduced on an EU-wide level a few years back, and we've now seen version 2.0 of that legal format, and that is also working very well. So therefore, absolutely, there have been successes that have been reached, and also they have been accepted by the wider public across all EU countries. But I have to say, if this takes 10 years, I don't want to hold my breath what is happening the next 10 years. So I would have wished for a quicker pace, a quicker speed, and hopefully we can see much more of those successes in the next few years.
Great. And I mean, in terms of European countries, is there one in particular that you think we should be imitating or looking at as we build the CMU?
So absolutely, we should look at best practices and we should see what is working well in each country, and hopefully we are able to export that model into the other EU countries and make it an EU-wide standard. I can just, being German, coming from Germany, I'm sorry to pick on a German example, but in Germany, 5 years ago, we had 1 million ETF savings plans. Now we have 7 million ETF savings plans. I explained before what an ETF is. A savings plan means that people are saving every month a certain amount, 50 euros, 100 euros, into ETFs, and these ETFs invest into the equity and or debt markets. So by now in Germany, we have 7 million people saving and investing on a regular basis, on a monthly basis, into the ETF product. And as I said, it's a capital markets product. It's either debt or equity. We all know about savings accounts, and we have too much money on savings account. So those 7 million people in Germany are an example that if you have an efficient product, if you have a cost-efficient product, and if you offer it in an easy way, people will trust it and people will accept it. For anyone who hasn't done it, please check it out. You can go to an online broker. You don't need to buy BlackRock ETFs. You can also buy other ETFs, obviously. But check it out. You can go to an online broker, and while you're sitting in this panel here, you can open a depot. You can do all the checks that you need to be done. You have opened your depot, and you can actually set up an ETF savings plan where you can save, 50, 100 euros a month, on an ongoing basis. So this has become very easy, very transparent, and people are taking it, right? We have huge success with that.
Great. So I know that we have to be very, very strict with the schedule, and we have 50 seconds left. So if anyone has like one sentence they want to say before closing the panel out, if not, we'll finish now. So I just want to thank all the speakers who joined me today for the really great discussion on the CMU. Hopefully in 10 years, the CMU will be complete and we'll all be investing in ETFs all day, every day. Now we have a coffee break until 5:20, so please go out, have fun, speak with each other, and then come back because we're going to have a panel on the EU's banking union moderated by my colleague Catherine Carlson. Thank you so much.
United in diversity. We are very heterogeneous in our opinion.
If we do not renew our partnerships with the rest of the world, Europe will not be relevant.
We can make it if we are together as Europeans.
Do you genuinely believe that countries will manage to reach these very ambitious targets?